The need for real estate analysis. Knowledge of real estate investment analysis is very important to a licensee in Florida because a real estate licensee is allowed to sell investment property. The public regards a real estate broker or sales associate as an expert in all type of properties. You'll find that when you get your license, they think you know everything about every type of property, where their house is, all kinds of stuff. It will amaze you. Now, while the rewards of negotiating the purchase or sale of investment property are often greater than they are for other types of real estate, so are the liabilities for untrained or unknowledgeable people. Investment terminology that you'll need to be familiar with is appreciation, assets, cash flow, equity, and leverage. The type of real estate investments we discussed in Chapter 1 is residential, commercial, industrial, agricultural, and business opportunities. Real Estate Investment Trust offers investors the opportunity to invest in income-producing properties. They generally specialize in a particular sort of property like multifamily, maybe retail malls, shopping centers, and office properties. The Real Estate Investment Trust provides individuals with the means to pool resources for investments in a professionally managed portfolio of real property or mortgages secured by real property. Real estate as an investment has both advantages and disadvantages. Some of the advantages are a good rate of return normally, tax advantages, hedge against inflation, leverage, and equity buildup. The disadvantages are illiquidity, meaning that real estate has poor liquidity. It takes a while to get it sold. Even if you found a buyer today, more than likely they got to get a mortgage so you don't get your money tomorrow. That's what liquidity means, how quickly you can turn an investment back into cash. Market is local in nature. You need for expert help. Also active management, and there's always risk. Some of the risks that are associated with general business is business risk, your operating risk. Financial risk, your operating financial risk. Purchase power risk, and interest rate risk. Risk that affect your return would be liquidity and safety. And there's two types of safety risk. You got your market risk and the risk of default. In business brokerage and real estate brokerage, you have similarities and differences. Some of the similarities are that there's transfer of real property or an assignment of a lease. That's why it requires a real estate license, because we're dealing with one or the other generally. The differences is that business brokerage has other assets. It's got personal property, goodwill, going concern, and a wider geographic market for sales. Some of the expertise that's going to be required in your business brokerage is knowledge about corporate financing, business accounting, and how to value a business. With corporate finance, you have classes and characteristics of corporate stocks, both preferred and common. There's security analysis and valuation. You need to know the management of your working capital and be able to budget. In business accounting, you need to be familiar with an income statement analysis, balance sheet analysis, cash flow analysis, asset depreciation, and taxation. An income statement analysis is a summary of income and expenses over a period of time. It's your profit and loss statement. The balance sheet analysis is different because it's a financial position at a certain point in time. It's your assets, liabilities, and capital. You have cash flow analysis, asset depreciation, and taxation. The ways in which a business is valued or determine the value of a business is by the comparable sales analysis, cost approach, and income analysis. They do use the liquidation analysis for businesses going out of business. The steps in the sale of a business, you've got 12 of them. List the business for sale. Identify all the assets of the business. Give the business a value. You got to deduct the liabilities. You got to give the stock value. You got to make sure it's in legal compliance with all laws. You got to get out there and market it. You have to find the buyer, and the buyer's going to sign a non-disclosure agreement. Then both parties will enter into a contract. They will establish a due diligence period. Now, the due diligence period, when it comes to businesses, is not to see if the building is okay. Like when you do a due diligence for a house, you want to make sure you do your home inspection, all those kind of things. The due diligence period for businesses is to check the books and to make sure the value indicated in their books is a true representation of the value that you're paying. You have the closing preparation, and you're going to schedule the closing date with all parties. And then after it closes, you collect that nice big check. Woohoo!